Good morning. This is
Morning.
Kara Kaufman with Care Home Team Real Estate, bringing you episode 6 of Everything Real Estate. Today we have Andrew Huber with us, and Andrew Huber is a partner with Smith Pauley. Andrew develops and implements estate and business plans that are customized for clients at all levels of wealth and stages of life using an interdisciplinary approach. Andrew focuses on traditional estate plans, for example, wills, trusts, and powers of attorney, to more complex estate planning techniques such as wealth transfer planning, asset protection planning, and closely held business succession planning. He listens and learns about his clients' personal goals and assets to incorporate their wishes into an individualized plan that is both comprehensive and flexible. Additionally, Andrew counsels clients through the estate and trust administration processes. In his corporate practice, Andrew provides strategic advice throughout the entire life cycle of the client's business. He regularly advises clients regarding planning decisions such as business entity formation, corporate governance issues, stock sales, asset sales, and mergers and acquisitions. So welcome, Andrew. We're glad to have you with us.
Thanks for having me this morning, Kara. Appreciate it.
Yep, you're welcome. So tell us a little bit about how you got into being an attorney and the practice that you now have.
Yeah, so when I was growing up, went to college and majored in political science and economics, and there's not too many things you can do with either of those. When I was an undergrad, it was a lot of reading and writing, and took a couple classes that were related to law, and just naturally found a desire towards those classes, and ultimately pursued law school. At that point in time, I thought I wanted to do more litigation, as I had experience clerking or working for other law firms, and they did more litigation related workers' compensation, personal injury type of law. However, as I went to law school, shifted away from that, ultimately wound up doing estate planning and corporate work. I just really like that area of law, as you really get to know the clients, figure out what their goals are, and help them achieve those goals. So it's just working with patients, clients, getting to know them. I really like that aspect of it.
Very good. So go ahead and explain how your business is good for investors or even individuals who are buying and selling real estate.
Sure. So for the investor who's looking to get into real estate, whether that's just one rental property or they're going to start building up and acquiring multiple properties, it's best to advise those clients to form an entity, an LLC, to hold the real estate. We do that for asset protection. That way, if something happens, there's going to be a shield there, and the creditor can only go after the LLC's assets rather than everything that the individual owns. So work with individuals to make sure they set up the LLC correctly, to provide them with that limited liability protection. So that's, one of the things there. Another nice thing about an LLC is it's relatively easy to create. There's minimal upkeep. Really, it's once every year, every other year, you have some filings that you have to submit to the Secretary of State. Also, it provides tax flexibility. So typically, an LLC that holds real estate, it should be set up so it's going to pass through taxation down to the individual member or members. So this means the LLC itself does not pay the tax. Instead, the income and losses are passed through to the owner. So, kind of those three reasons: the personal liability protection, easy maintenance, and the tax flexibility are three of the main reasons to create an LLC for that investor coming in to buy real estate.
So if somebody puts it into the LLC, is the taxing then pretty much the same as if it was not in an LLC?
That's correct. So it's going to pass through to the individual. So let's just say it's a single member LLC. So John Smith goes and forms, John Smith Real Estate Holding LLC. the gains or losses that that LLC creates are going to pass through or flow through down to his personal income taxes. So it's going to be taxed at the same rate as him individually.
Okay, very good. And then that also then protects them that anybody that wants to sue for any reason cannot get into their personal items, correct?
That's correct. Yeah. So with the LLC, assuming it's set up correctly, meaning that the LLC has its own bank account, the tenant is paying monthly rent to the LLC, then the company turns around and follows those formalities. If something does happen, that owner is not personally liable for any business debts or damages stemming from lawsuits brought against that company.
Okay. Very good.
Others, sometimes realtors, I also work with a lot of realtors and create LLCs for them. So the majority of real estate agents are self-employed or independent contractors. Even those agents who work for brokerages, they tend to do so in that capacity as independent contractor or self-employed. So they can create their own LLC. So it could be John Smith, real estate agent LLC. They set that up for various reasons as well. One, it provides for the personal liability protection, same as what we discussed for the investor clients previously. If something happens, it's limited there to the LLC and not their personal assets. Also, there's tax flexibility. So an LLC can elect to be taxed as an S corporation status, and this can potentially save that realtor money on self-employment taxes because you make the S election. There can be some tax advantages to making that election. You would not want to do that for the investor who's holding real estate because there's holding real estate in an S corporation creates negative bad tax implications. So we avoid that at all costs. But if it's an individual and the company does not own real estate, we might look to see if it makes sense to make that S election, as it can save on self-employment taxes. Another benefit of setting up an LLC for a realtor is separating business and personal finances. And then finally, it might raise professional credibility of, oh, so-and-so has their own business set up. So they, it might bring them more credibility to, prospective clients.
Sure. Very good reasons. So anything else on the LLCs before we move to possibly trusts?
Not really that I can think of right now. That's kind of just a high level overview, but LLCs are very common for investors wanting to get into real estate. You can put one property in it, or you can put however many properties you own. Want to discuss pros and cons to having multiple properties in one LLC. Like I said earlier, it's easy to set up and administer. There's can be tax benefits for the realtors as well. So both of those reasons are common reasons to create an LLC for investors or realtors.
Okay. So then switching a little bit, why is it that somebody would put their personal home into a trust versus not?
Sure. So individuals typically, as part of their estate planning process, might look to put their house to retitle it from their individual name into a revocable trust. So a revocable trust is a separate, it's just a entity that's really designed to dispose of your assets upon your passing. And it avoids probate, which I'll address on that here momentarily. But if you put the house or property in the trust upon your passing, we don't have to go through probate. And so it avoids that long process. A lot of people hear the word probate. Maybe they know what it is, maybe they don't. Really, all probate is a court supervised administration of an estate where the court ensures that the decedent's debts and taxes are paid, and then any money left over is distributed to the individuals entitled to receive it. So
And
probate kicks in upon somebody's passing. And then upon their death, we're going to look at that individual's assets and see what assets they have and how it's titled. So not every asset goes through probate. So if let's just say there's a bank account that's titled solely in the decedent's name, that asset is going to be subject to probate. Let's say there's a house that's titled John and Sally Smith as joint tenants with rights of survivorship. Upon John or Sally's death, that property is not going to be subject to probate. Instead, it automatically transfers over to that surviving spouse.
okay.
And so each state has various thresholds for estates, which if the decedent exceeds those, that might require a full probate. So for example, in Nebraska, if the decedent has, at the time of their death, real estate titled solely in their name greater than $50,000, or personal property, which is all non-real property. So that could be boats, vehicles, bank accounts, household items, cars, valued at $100,000 or more. And those assets are not passed to beneficiaries by some form of beneficiary designation, whether that's transfer on death, payable on death, or joint ownership, then a full probate proceeding is needed to administer the estate. And again, that's where we go to that court and say, okay, here's the probate assets the decedent had, here's the debts that he or she had, and here's any taxes that need to be paid. And then after that, we look and say, okay, does this person have a will? If so, then the terms of the will govern where that money goes. If they don't have a will, Nebraska creates one for you. And that may or may not be what you want, but that's the default. And so Nebraska law just says, well, if you don't have anything, here's who we think it should go to. So, then we look, okay, the decedent, were they married at the time? Did they have kids? And so we just kind of have a flow chart that we walk down if that's the case. And so, like I said, a lot of times that's not what people want. And so that's why I cannot overemphasize enough the importance of having an estate plan.
Correct.
So
Yep.
an estate plan, that's going to be a last will and testament, healthcare power of attorney, financial power of attorney, a living will or an advance directive, and then possibly a trust. And so what the last will and testament does is that's going to say where you want your assets to go. We look at that at the time of your death. It also appoints a personal representative. That's the person who steps into the decedent's shoes at the time of their death and pays any expenses, pays taxes. If there's any debts, they pay that. And then any money left over, they say, okay, here's who it goes out to. The other thing that a last will does, if you have minor children, is you would name who you want to be guardian and conservator for any minor children. So in the event mom and dad both pass away with kids under the age of 19, who's going to step in and assume guardian for those children? If you don't have one, then you have to go down to the court and open up a emergency guardianship proceeding, which takes time and it's a hassle to do that. So it's another benefit of having a will.
So question I have regarding probate. So if somebody that owns a house their property is going through probate, does it have to wait until that whole proceeding is complete before the home can be sold? Or is there a point that it can be determined that yes, it can be sold?
So it doesn't have to wait till the very end. But I will say it kind of depends what's going on in that probate. Is there litigation or there tax liens? Various things like that. Assuming it's a straightforward probate, once the personal representative has been appointed by the court, that individual gets what's called letters of personal representative. They can then take that and sign the purchase agreement, enter into the sale of the real estate.
Okay.
It could slow down the sale a little bit if it's going through probate. It depends where at in the process. But the title company is probably going to want to make sure there's no liens on file with Nebraska Medicaid if it's a person aged 55 and older. If they were on any Medicaid or services that the state provides, the state needs to get paid back. So that, we have to go through that hurdle.
Okay,
Otherwise, no, the personal representative can sell the property prior to the closing of the probate.
okay, very good.
So then we talked about the will. We also do a financial power of attorney. This document's important because that's going to be effective during your lifetime. So many times when people hear of estate planning, they just think, oh, where does my stuff go upon my death? You also need to kind of take a step back and say, well, if I'm incapacitated, who do I want to take care of me? Who do I want to make financial decisions on my behalf? Who do I want to make healthcare decisions on my behalf? So that's also another critical aspect of estate planning is the powers of attorney. So the financial power of attorney, that's where you appoint an agent to make certain decisions on your behalf. That's typically pretty broad. It could be things such as buying or selling real estate. So let's say, you become incapacitated, and you can't sign the purchase agreement. You can have your agent sign on your behalf. Buy or sell, they can deal with banks, they can deal with your financial institutions, enter into contracts, they can do certain things. Upon your death, that power is revoked, and then that's when the personal representative would step in. The other thing with the financial power of attorney, you can have it be effective immediately once that document is signed, or you can wait and say, my agent doesn't have any powers until I'm incapacitated. The
Very good.
healthcare power of attorney is similar to the financial one, only it deals with the healthcare decision. So it allows somebody to speak to your healthcare providers on your behalf, view medical records, and communicate when you otherwise can't.
Okay, so going back just a minute to the financial power of attorney, you were talking about the agent being able to buy or sell. Do they have to, they just have that power rather than the person being able to say, yes, you can? Or at the beginning when they set it up, do they say you can do real estate or no, you can't? I mean,
You would have
that?
You would have the ability to say, I want my agent to have the ability to do X, Y, and Z, but you can also put certain restrictions on what they can and cannot do.
Okay. Very good.
Another important document is the advance directive or the living will. This deals with end of life decision making. So think about, if you're in artificially, a feeding tube, breathing tube, end of life would be imminent. But for that, do you want to direct to your agent at that point in time to make the end of life decision? Or do we want to put some sort of parameter on it? Maybe they need to wait 48 hours, or maybe you don't want agent to make any decisions. That's also critical to think about. What do you want to happen in that scenario when it is end of life?
Definitely is very, very important. We're going through that right now with a friend, and it would have been nice had she at least made her wishes known prior. Yep. So.
And then another document that, the individual client may or may not need is a trust. And so really all a trust is, there's various types. People probably have heard revocable, irrevocable trust, and they wonder, do I really need that? That's only for the, very wealthy. All a trust does is, a revocable trust is designed to dispose of your assets conveniently at the time of your passing. I view a trust as nothing more than a toolbox. So the revocable trust, during your lifetime, you can put assets in it and you can take assets out of it. So like we discussed earlier, maybe you want to put your house in your trust as a way to avoid probate. That's perfect. You can retitle that. You can do a deed and convey that property from your individual name into your trust. Then let's say 5 years later, you decide to sell the house. You have all the authority to do that. So again, asset can go in and it can go out. You can change it, it's revocable, but upon your death or incapacity, then it becomes frozen and we can't make any changes to it at that point. And then it's going to dispose and say, okay, upon my passing, I want my assets to go to X, Y, and Z. You can be very, creative with this. Common ones that we do are for younger families with young kids. Maybe they say they want their kids to get the assets over a period of time rather than at 19 they get everything, because chances are a 19-year-old wouldn't be very financially wise with a large sum of money.
Yeah.
We put restrictions on it. We can say, okay, you get a certain amount, maybe 1/3 at age 30, 1/2 at age 35, and the rest at age 40. And you can use any ages, but that's a common one. Another one is we say, okay, it's going to stay in trust for the beneficiary's lifetime. Benefit of that is creditor protection. So if they get a divorce or they get sued, that creditor can't get their hands on the trust assets because the trust owns it, not the individual. Another common one is just outright distribution. So if your kids are older, you trust them, you don't think they're going to have any creditor issues, then upon the passing, everything goes outright to those individuals.
Okay.
And then with the real estate, you can do, all sorts of planning with that. It could be, maybe you want the property to stay, let's say it's a lake house. You could hold that lake house back in trust and you could allocate some money. And then the trustee who's in charge of the trust at that point would use that money for maintenance, maybe taxes, utilities, and then the kids have equal access to it during their lifetime or for a certain period number of years. And then you could say, okay, one of them has the right of first refusal, or they all do, meaning when the trustee decides to sell the property, one of those kids could buy it first. Or you could put discounts and say, okay, I want this kid to buy it at 80%, because he or she lives here, he takes care of it. So you can get really creative with real estate and what you do with the trust.
Okay, very good. I appreciate all your information. Is there any last comment you want to make before we get ready to close up?
No, I would just stress the importance of having an estate plan. It really doesn't matter if you're 18 years old or, near the end of life. Doesn't matter if you have $100 or $100 million. Everybody needs to have an estate plan, just because you need to make sure what happens. You want to plan for who takes care of you during your lifetime if you become incapacitated, and you want to say who you want your assets to go to upon your death and under what conditions.
Okay, so one quick question, going back to probate. So if someone passes away, does not have a will, and does not have much possessions, and I think you said what there's a minimum of 50,000 to go through probate.
50,000 for real estate. So
for real estate, okay.
Yeah, so with today's real estate market, essentially any real estate you own in Nebraska is likely going to be above that 50,000. So then you're going to have to go through the full probate. But let's say personal property is less than 100,000. We could bypass probate and just do what's called the small estate affidavit, which is a one-page document just saying, okay, so-and-so died on this date. We've waited so many days, or so many days have passed since his or her death. Here's the assets. It's less than $100,000. And then you could take that affidavit to the bank, and then they would pay out to the beneficiary or beneficiaries that asset rather than putting it through probate. So it just expedites the process.
Okay, very good. All right. Well, I want to thank you for joining us today.
Absolutely. It was a pleasure.
I learned a lot, and I hope everybody else does. We appreciate you. And if anybody wants to contact Andrew, you can contact him at 402-392-0100. 888-432-0101, or you can email him at ahuber@smithpauley.com. And if you have any real estate questions, you can contact me at 402-798-4364. And I hope your day is filled with joy and peace, and you have a wonderful time. Thank you very much.
Thank you.